This Canadian business owner owed the CRA about $4 million in taxes, and he paid $350,000 in taxes instead. And his kids ended up with roughly $3 million more than if he had done absolutely nothing. So, same business, same value, just a completely different plan. So, here's the situation, okay? He built a company worth about $12 million. He's got an investment portfolio on top of that, and he's planning to hand the business to his children over the next 3 to 5 years. So solid position to be in. But here's the problem, okay? There was no estate freeze in place, which means that the business kept growing and the tax bill on the deemed disposition kept growing right along with it, meaning that whenever you die in Canada, it's as if all of your assets were sold that same day, right? So this is what deemed disposition actually means. So that $4 million wasn't a fixed number. It was getting worse every single year. He waited and nobody had shown him a way out of it. So he pretty much accepted it as it was. So just the cost of building something valuable in Canada. Then the advisor that met him, which in this case was Elise, one of our advisors that we partner with Preserve Wealth Group, told him something that changed the entire conversation completely for him. So she said, look, you've got three places your money can go: the CRA, yourself, or a charity. And you only really get to pick two. Choosing charity doesn't mean you're disinheriting your children. It means that you're disinheriting the CRA, which for most of us, that's what we want to do. So that reframe is what opened everything up. So here's the strategy, okay, that Elise was able to put with that business owner. There was three moves. First, the freeze, right? So she locked the shares at today's $12 million valuation so that all the future growth from here flows to the children's shares instead of his. So that stopped the bill from climbing while everybody gets organized and the transition plan was built out. Second, the donation. So he donated a portion of those frozen preferred shares to a charity that he actually cares about. And this is the part most business owners have no idea about, because you can donate preferred shares of a private company, and that donation generated the tax deduction that brought his $4 million tax bill to the CRA down to about only $350,000. And it created capital dividend account credits, which is how money leaves a corporation tax free instead of getting hit at 53% again on the way out. And finally, third, the insurance. So a corporate owned permanent life insurance policy designed to replace the value of what he donated so that when he passes, the death benefit lands in the corporation tax free and credits the capital dividend account a second time. So his estate is whole. His kids aren't short a dollar whenever that disposition will happen. So the outcome of that is that three moves and one integrated plan together, the tax bill was down by 91%. So net corporate estate value was up about $3 million and a $5 million legacy donation going to a cause that he genuinely cares about, that his kids get to watch him build while he's still alive. So the advisor was honest about this. From day one, she said it doesn't always come together this cleanly. What made it work for this specific case was the runway. So he came in 3 to 5 years before the transition instead of after the sell when it's too late to do most of this. So look, if you're a Canadian business owner watching this and you're 2 or 3, even 5 years out of handing your business to your kids or selling it, that window is when everything gets decided. So the strategies that save you millions require time to structure. And once the sale happens, most of your options disappear. So at Preserve Wealth Group, we connect business owners with independent licensed specialists in Canada and in the United States. So who build this exact same plan that I've just presented in front of you. So links below if you want to have a conversation while you still have the runway.